They are lying to you about inflation, and here's how to fix it. Now, inflation has been the hot topic, of course. We've been hearing about it nonstop for the last 2 years, and you see it, you feel it every time you put gas in your car, food at the grocery store. It's getting hard. It's getting hard to live. Your standard of living is going down. Now, a lot of us are thinking about how do we hedge? How do we protect ourselves from inflation? What investments can I get into so I can increase my purchasing power? But the conversation I'm having today with Parker Lewis is a little bit different. Instead of trying to protect yourself, how do we create a new system so we never have to worry about it again? We're gonna dig into that. We're gonna talk about the pros and the cons. There's a lot of negative beliefs that people have about this. We're gonna dig into that. What happens with economic growth? How does the system work? And so many other things. It was a great conversation with Parker Lewis. Let's go ahead and just jump right into it. Thanks for welcoming me into your spot. We're in your spot inside Marty's spot. So shout out to Marty Ben for letting us use his studio. Tales from the Crypt. Always a pleasure to sit down and hang out. And so let's talk about this. You recently put out a new article. You came out of hiding.
Yeah.
Came out of sabbatical, decided to write again. A lot of people maybe don't know, but you've written a long series. And I didn't know this was your 18th installment or issue.
Yeah, kind of there was a blitz between 2019 and 2020.
Yeah.
And then the last piece that I wrote for Gradually and Suddenly was December of 2020.
Yeah.
And hadn't written, had written some in between, but not as part of the series.
Yeah.
And had something that a few other things that I wanted to say and didn't have enough time to write and dedicated to get back to it. So
bear markets are for building. And so here we are in a bear market and you're back to writing again.
That's right.
So I would have guessed maybe there was like 8 or 9, and I thought I've read them all. I don't know, 18, that's a lot. Gradually and Suddenly, I don't know, does that come from like the Mark Twain quote, like how'd you go broke?
Hemingway,
sorry.
Yeah, and I think it was technically first slowly, then all at once, and then culturally kind of morphed into Gradually and Suddenly.
Yeah. So let's talk about that new issue that you wrote here. And I think when I read it, like it seems like the theme of it is inflation. That's kind of what I take away. So you talked about the hedge, volatility, risk, but really hedging risk from like inflation. So let's start and talk about inflation.
Okay.
I think that's the topic to talk about. It seems to be kind of the lightning rod here. Inflation has been raging. The Fed wants to get a 2% inflation. They haven't been able to get it. 2015, 16, 17, 18, 19, 20 couldn't get inflation. Jerome Powell said, well, let it run hot. And they overshot. They got to 9%. It's coming back down 6.5%. But the Fed says they're committed to it bringing inflation back down. You put in your paper that what do we have? 10 to 1 dollar denominated debt or demand versus the dollars. $9 trillion in actual dollars, 90 trillion in dollar debt. So let's talk about that for a minute. You said inflation is a man-made phenomenon.
Yeah, I think that one of the points that I make in the piece is that and you should really try not to watch CNBC or kind of mainstream financial news, but whether it's mainstream financial news, CNBC or Bloomberg, or academics at Western universities, there will be a lot of debate about what causes inflation.
Mm-hmm.
Like where does it come from? And it will almost be dismissed as, well, we can't really know. Like, some people say X, some people say Y, some people say Z, but only the Fed creates dollars. Only the Fed can create more dollars. The Treasury prints dollars, but that all source of dollar inflation comes from increasing the supply. It's that simple. Even people who, there's even debate about people who are maybe not so much in the mainstream, but macro investors who I think more and more become susceptible to this groupthink, and they say, oh, it's the expansion of credit. But it's like, just simplify it. It's like if you create more dollars, and the Fed does, and they have, then that is what produces dollar inflation. That is what causes every unit of the dollar to purchase less over time. And I think the thing that trips people up, which is one of the subjects of the piece, is helping people understand how the system works, how it's revolved around a credit system, and that what people struggle with is how the creation of money gets distributed and how that impacts prices. But it's very simple math. You create 10x the number of dollars. Doesn't matter kind of how and when each dollar will purchase less, and it's to simplify it and to not get caught up in the minutia of the detail, because you fail to see the forest through the trees. That if $1 trillion or $0.9 trillion existed in the U.S. system in totality in 2007, now 9 trillion do, or approximately 9 trillion. And it doesn't really matter how and where it appears and where it's more or less. That is the core function that drives it. And it happens functionally by a man-made institution. It happens technically by a man-made computer where they click a button and they credit JP Morgan's account with more dollars, or Bank of America's account with more dollars, or Citigroup with more dollars, and then those dollars start to come out into the system.
Yeah. And that's any time the monetary base expands faster than the products and service base.
Right.
Not just dollars, but money, if we want to call it that. Not to get into semantics here. But, you know, if you look at like the 1500s, Spain went out on expeditions, went to South America, found the biggest
gold,
the biggest silver deposit in the world, right? Brought all that silver and caused massive inflation because they rapidly expanded the money supply. So same thing you're saying.
Yeah, and that's exactly how I think about it. That because when the money is actually created, and given it's a lot easier to see it now that the scale is so great, but from March of 2020 to May of 2020, the Fed created $3 trillion. And they were creating hundreds of billions of dollars a week. That if you really simplify it down to the second that they click that button on the computer screen to credit 600 billion in a week, at that time, I think the money supply was probably 3.8 trillion. So could the goods in the economy possibly have increased by 30%?
Certainly not.
When a click of a button happens,
Yeah.
Absolutely not. I think more fundamental is the point that the operation of money creation, either a clicking of a button or printing physical dollars, that does not produce oil.
Right.
That does not produce more food. That does not produce any good or service. It really is extraneous. So, kind of the more fundamental piece that I make or argument that I make in the piece is that process of creating money, not only can goods not keep pace with it, empirically they don't, and technically the way it happens, they don't, but I think more importantly, the process of creating money, not only can it not produce oil or food or power or water being delivered to your house, it actually distorts the ability to deliver goods to market.
Yeah.
And over time, it slowly degrades or slowly becomes impaired until ultimately it breaks down entirely.
Yeah, I want to talk about that. You wrote a good piece that I clipped out. I want to talk about that. But just to kind of even show how much bigger this problem is, the Fed creates money, a couple $1 trillion, as you said, and inject that in the system. But even more, they set the price of money. So there's a cost to buy money. If I want to buy a house, I need $1 million. I have to go buy that through a loan and the interest rate. So they set the interest rate low, which then makes all of us go take on more debt, which then also creates more money. So then they injected the $3 trillion. The government injected, but then we all went and created a bunch of money by adding debt. So it just rapidly expands. But you said in the paper, mistake people make, especially academics, is believing it can go on forever. It seems to have gone on forever. 50 years potentially at this point, 51. Just print a little bit more money, even a lot, and the goods and services will merely cost more dollars. What's the big deal, you say? The Fed has been doing this for decades, nearly a century. If money were simply basic math, it would be the case, but in reality, the function of money is a highly complex and consequential. It coordinates all economic activity. And so you say that if they continue to do this, it fundamentally impairs the currency's ability to coordinate economic ability. So explain that, how that gets coordinated and how that messes that whole system up.
Yeah, so I can't remember if I put this in the piece or not, but one of the examples that I know that I have in the piece was where I just took a random tweet where I saw somebody in the oil and gas business comment on how the price of goods in their supply chain had increased so much that they were debating whether or not to drill oil, because they were somewhere between, do I do this now? Can I afford to do this now? And I'm making this decision of to not produce oil because there's rapidly changing prices. Mm-hmm. Another way to think about it is what happened in the financial crisis. Or the housing crisis that coincided with the great financial crisis, when They flood the money with the system with money, reduce interest rates. They, like you said, they set the price of money. But the other side of that is they're setting the price functionally of maybe a mortgage, right? That then translates into the price of a house. And what functionally happens in the economic system is that based on a false signal, the manipulated price signal of what a mortgage costs and then what translates to a house, that a bunch of people who otherwise might not have trained themselves on the skill of building homes, selling homes, and there's a whole economic system, and then there's a collapse and there's mass dislocation because the price levels are unsustainable unless they continue to drip more money in the system. And that the money kind of, I'd say the manifestation of the money becoming impaired is that where in a natural economic system there wouldn't be mass dislocations, but if you are manipulating price signals and manipulating the money supply and ultimately the pricing mechanism for the economy, which is the money, for decades, then you can have these massive dislocative events in a system because you have big mismatches in what can actually be delivered on a sustainable basis and what true price levels are or clearing price levels in the market. What it naturally concludes with is hyperinflation, where the money in the economic system breaks entirely, and people have been kind of lulled to sleep around the idea that this has been going on for a long time. But realistically, in the if gold and commodity metals emerged over thousands of years as a form of money, we are only 50 years removed from the dollar or any fiat currency being untethered to any commodity money which preceded it. And that's not a very long period of time, in terms of an economic system. And that, one of the other pieces that I wrote was Bitcoin is common sense, which there's two old adages, which are there ain't no such thing as a free lunch, and money doesn't grow on trees. So did money magically begin to grow on trees, or are we living in an unsustainable kind of system and period of time, and we are actually seeing the manifestation of that come to fruition? Inflation running hot, kind of people looking at the total number of people employed in the system versus total number of people in the country, and so and we've had financial crisis after financial crisis. It's like something is broken. Most people feel that or sense that in their daily lives. They just don't connect it to the root cause, which is the money, and the money degrading slowly, becoming more volatile. And if you can, another thing that I think is fundamentally true is if it costs zero to produce money, people cannot continue to trade real goods and services, oil and gas, power, delivering water and waste management systems, telecom. If it costs zero to produce $1, it costs zero to produce $1 trillion, $3 trillion, that over time more people figure out that this good, the dollar, cannot sustain themselves. They can't deliver 8 hours of work in a day, 40 in a week, thousands in a year, and convert that into something that bears no cost to produce.
Right. Yeah. As long as one group of people are stuck trading their time for money, and another group of people can create money out of thin air, then one group will always be in slavery to the other, right? They can just basically steal their life through that inflation. So let's talk about that for a minute. So they measure this rate of inflation through CPI, consumer price inflation, right? So they're supposedly tracking a basket of goods as it goes through time, which seems like the true definition of inflation, maybe the Austrian definition of inflation would be measuring the money supply. Does the money supply expanding or decreasing? And then the prices would be a result of that, right? But they give us this CPI calculation. We saw that we hit the highest point in 40 years. Was it last year at 9.1%? It's trending down 6.5%. The Fed is committed to bringing down inflation. All eyes are on inflation. People are feeling the pain at the grocery store, the gas pump, et cetera. I don't know if you saw this, but I think just this week, the BLS came and changed how they're going to calculate CPI. Did you see that?
Yeah, to change it from, I think, 2 years of data to
1 year of data. And that matters because last year CPI was at the highest rate. And so if you're measuring a year over year change, it automatically brings CPI down. Now, it seems to me that the Fed is going to use that to continue to manipulate and lie and then be able to get around and probably go back into some sort of an easing type scenario. But of course, it doesn't do any good for helping the people at the gas pump, nor does it help people make economic decisions. So this just puts us even further into trouble, it seems like.
Yeah, and I think, I mean, one, how they measure inflation, you know, like I think in the summer of 2021, there was the propaganda came out that a 4th of July dinner was like 16 cents less than it was the year before. It was like 16 cents of deflation. And it's like anybody who is buying goods and services at that time, you know, buying a 4th of July, you know, dinner or lunch or materials knows that their costs were going up.
Yeah.
You know, so I think how they change the measure, one thing is that the measurement itself before was flawed, right? It's like CPI, regardless of if they're changing it from 2 year to 1 year, it's measuring a basket of goods, but ultimately it's tied to your income. Your income is tied to the credit system because that, you know, it's like base money and then ultimately money creation through credit. That is what dictates in total how many dollars are circulating and how many dollars can be spent, how many dollars can be paid to you. And so the idea that, you know, if they increase the money supply by, you know, in March of 2020 at 3.8 trillion, and now it's close to 9 trillion, so they created $5 trillion. But if your income didn't double, you still have, you know, and you were making $60,000 a year, things start to get more expensive that you used to buy and you start to substitute. And so rather than measuring inflation as what did a ribeye cost this year versus the next year versus the next year versus the next year, what did a house cost that has inputs? What does a door cost? What does wood cost? What do basic materials cost? That you actually, the right way to look at it would be looking at the same exact good year to year that doesn't change the input cost, the raw material. And instead what they do is like if you substitute from a ribeye to ground beef, or from a ribeye store bought at the grocery store to a Big Mac, that the way that they even set and do the calculation on CPI, it's all driven by income levels, which are tied to the system that they control. It's like it's a circular reference. And so, you know, it's more to make the point that the measurement was always flawed, but also changing how they measure it. You know what your standard of living is. People are not dumb. They know that the things that they used to rely on as part of their own standard of living cost a hell of a lot more than 9%.
Yeah.
Right? Like steak at the grocery store, you know, power, everything. It's like
saw eggs.
20%, 40%. Yeah, like it's, you know, and I consider myself fortunate because I have a lot of savings, but it's difficult to even go to the grocery store of the things that I would buy. And I think this is one place where people really, like what I probably heard most consistently is people go to the grocery store and buy a bunch of goods. And I heard people say like, I had my first $300 grocery trip, or I had my first $400 grocery trip, or I had my first $500 grocery trip. And they're, you know, because in the kind of academic world, people will talk about a basket of goods. That is an actual basket, right? And people were noticing that they might have noticed that an individual good went up, but then also when they were getting to the checkout, that they were above a hurdle that they had never been before, and that if the food and the things that you were used to be buying cost 30% more, inflation isn't 9%. It's 30%.
Yeah.
You know, or if they're 20% more, and that also is tied back to what we talked about before. The creation of money cannot produce more of the goods that you are relying on, and what ultimately happens is people substitute down. They buy lower quality goods, and so it really is just, you know, it's somewhere between propaganda and just dishonesty. But I ultimately, you know, it's like it doesn't really matter what the BLS is saying as CPI. It matters what you yourself buy, what you had become accustomed to as your standard of living, and having to make choices to degrade that because your wallet is not expanding as quickly as the goods that you used to demand.
And it doesn't just do that. It's also, as you already kind of said earlier, it messes up the whole economic equation. And so because I have faulty data now as an entrepreneur, business owner, I'm making poor decisions. And then that affects the supply chain. So now not only are you not able to get it because of the demand, but now I'm not able to provide it as much either, and that also messes up the supply. But then even worse than that, like look at the like socio or just the societal impact. So for example, I saw this, eggs were all over the news the last couple weeks, skyrocketing in price. So people are substituting organic eggs for non-organic eggs. Or I'll just have a bowl of sugar and carbs and cereal for breakfast, right? And so now I'm having to choose lesser options that are less good for me, which then causes health problems and concentration problems.
But like when you substitute down, right? Like say you used to buy organic eggs and they were $4 a dozen.
Right.
And then, because this is how it actually works. Say the same organic eggs cost $6 now. So that 50%. I guess, they cost 50% more. Maybe it's 33% inflation. However you want to look at the other side of the coin. But if you decide that you're going to buy 12 non-organic eggs and they cost $4.25, that change from $4.25 to $4 is what's included in CPI.
Yeah.
But the goods that you used to demand and that were higher quality are more expensive. By 50%.
Yeah.
Right. So that is the flaw of the CPI calculation as it relates to kind of thinking about or trying to conceptualize how the system in aggregate gets so screwed up. And this is, and it's not just being pejorative towards the academic world, but people oftentimes think of, well, if more money's created, then everything's just going to cost more. And that one of the fun, when I talk about money coordinating all other economic activity, that the price system is an output of convergence on a common form of money. And that a very important piece of information that we learn through the price system is the relative value of all goods to each other.
Right.
So if a house costs $500,000 and a car costs $50,000, that the price the price of an individual good is relevant, but also the exchange ratio between house and car. If I'm an auto manufacturer, how many cars do I need to sell to be able to buy a house? And that when that relative price of goods is almost more important in an aggregate level than any individual price, because it's what dictates all action. It's what allows people to conceptualize, hey, if I want to live in that type of place, what type of income do I need to make? If you think about budgeting. And that if you just thought about, well, if I doubled the money supply and if everything changed ratably, if everything was just double, maybe that wouldn't be such a terrible thing. Because the relative value of all goods to each other didn't change.
Right.
But that's not how it works. That the money doesn't just go into everybody's, however much money everybody in the economic system had, they now have X percent more. Now, in an academic way that might work too. It doesn't. But
in a theoretical way, maybe.
But it's also not what happens.
Yeah.
That the new money that's created does not get distributed in the same allocation as it was before. And the economic system as a whole actually fundamentally changes. The proportion of who holds the money changes. And what that does is it distorts the relative value of house and car and Apple, car and power, oil and gas, everything. And so everyone is being sent these signals to say, hey, like, I need to buy a house, but like the houses are too expensive for me before, so I won't do that right now. Or I need a car, or whatever it is that you need, that the relative value, because the money gets distributed unevenly, and it's not just to say that the Fed chooses this person over that person, but in a certain way, if they were targeting mortgage rates, it advantages the housing sector over everything else. And there's people at the Fed who even talk about that, like post-financial crisis, where there were critics even within the Fed that were challenging what they were doing, saying, we're not a hedge fund. We're acting like a hedge fund where we used to only buy treasuries. Now we're advantaging one sector of the economy over the other. But that really sits at the core of why when they create money, it does a lot more harm than just make things more expensive. it fundamentally shifts the balance of power in the economic system and advantages certain goods or certain sectors of the economy more than others. And in this system, realistically, sectors that depend more on the function of credit get disproportionately advantaged.
Right. Because we're in a debt-based monetary system, then you have to use debt and credit in order to get wealthy.
Or to think about it as a producer, if people use mortgages and put 80%, 20% down, 80% in a mortgage, or you see advertisements for automobiles, no money down.
Yeah.
Right. Anything that the funding mechanism is disproportionately reliant on the function of credit or credit as a funding mechanism, it's not just that it kind of induces people to get into debt. It's that the auto sector and the housing sector, versus, if you just go buy a consumer product, you're not generally funding that with debt.
Yeah.
Right. That it disadvantages advantages the producers of those more so than others in the system.
I want to talk more about that specific topic of credit and for producers issuing credit, but I want to come back to that. So let's jump into the other kind of point of your article, which is obviously was inflation, but you were talking about hedging against inflation. And so I think everybody knows you shouldn't save your money in dollars. I think we all just know that, maybe just instinctively or seeing our parents or watching TV. But so people are putting their money into anything they can, stocks, real estate, bonds, art, whatever, right? Just to try to stay away from the dollar because they know the dollar's losing value without really thinking it through. But it's inflation that's the problem. And so they're hedging against inflation. And in the article you were talking about how Bitcoin has typically been viewed as a hedge against inflation, but you think it's a lot more than a hedge.
Yeah, well, I think that part of what I was trying to explain in the piece or make a case for, argument for, and I've never personally thought of Bitcoin as an inflation hedge. I came to understand Bitcoin first because I understood why the Fed would have to print a lot of money into perpetuity. I recognized that was a problem and that we would need an actual solution. And that I think a big part of it is that people do, whether they're conscious of it or subconscious of it, they know that the dollars in their bank account are going to lose value, that is a certainty.
Right.
And they deal with that certainty in different ways. They manage the symptoms of the dollar losing value. Some people might not know that the Fed creates money, but they know that the dollars in their bank account, that's the price signal, that they purchase less over time, and that there's a disincentive to hold dollars. And it doesn't mean that everybody takes the same action, but there are certain goods that historically have been used as an inflation hedge to offset that decline. Gold has historically been that, as people shifted to using real estate in expectation that if they're going to create money, or even if I don't know that, if I know that the dollar is going to lose purchasing power, that what are the goods that have consistently tracked that or offset that? Yeah. And I think there is a fundamental difference than making an investment that is designed to offset the decline of the dollar, essentially to either hold its purchasing power or increase in purchasing power sufficiently to offset the decline in the purchasing power of the dollar, and to find something that can actually solve the problem permanently.
Do you think, though, just real quick, do you think that most people, the majority, maybe they're not actually looking at it as the decline of the dollar, like, oh, my dollar's losing purchase power, I need to do something to hedge that? I think they're looking at it like prices are going up so fast, if I don't get my money to make me more money, I won't be able to keep up with the prices going higher, which is the same thing.
That is how the price signal that they recognize is that the goods that they used to purchase cost more. Right. That is the dollar declining in purchasing power. They do. I think I would gather that the average person thinks about it as, if a house used to cost $100,000, now it costs $500,000. Right.
So it's the same thing to us, but I just want to make that clear for people watching, because I don't think most people equate it to the dollars losing power. They just see prices going up, and I need to be able to keep up with that.
Yeah, and because the dollar's in the account, like one time because it's odd to think about it this way, but I do think it's the correct way, is that, and it's consistent with, I think, the more true way that someone would measure inflation based on their daily lives. Not say that that's how they do it, but if a Bud Light used to cost $1, and now a Bud Light costs $4, then what is the value of $1? It's a quarter of a beer now, and it used to be one.
Yeah.
And so it is the inverse, but because the dollar is the unit of count, we think about everything in dollar terms versus the inverse. It's not really intuitive to think about a dollar as being worth if a beer costs
it's not intuitive,
$4,
but it's very helpful.
right? But it is functionally what's happening. Each dollar is purchasing less of the good that you used to demand, and exactly as you said, if I want to continue to sustain or maintain the quality of life that I had, I need to figure out how to turn my dollars into more, such that I'm not able to only buy a quarter of what I used to be able to buy.
Right. Yeah. So we're hedging against that. We're trying to put them into real estate. We're trying to put it into stocks so that hopefully that it can buy us more Bud Light, or the same amount of Bud Light in the future. And then back to kind of your paper. So you're saying it's not just a hedge. So Bitcoin isn't just another real estate stock option, another option to hedge against it, but it's actually a way to change the system so we don't have to deal with inflation anymore.
Yeah, and I think the point that I raised there is, first, there is something fundamentally different about, say, investing in real estate as a hedge to inflation, with the idea that you're going to get out of the dollar into a piece of real estate. That real estate is going to increase in purchasing power to such an extent that it offsets any, whether you think about it as increase in the price of goods and services that you choose to demand,
right,
or a decline in the dollar, such that investment, I buy real estate for the purpose of getting back in a dollar so I can go maintain my standard of living. That is very different than recognizing that there is something fundamentally broken about my money, and that while it might be intuitive that the piece of real estate is not performing the same function as the money, because you're not converting a piece of real estate for groceries at the grocery store,
right,
you're converting into money and then using money. The function of money and the function of real estate are different. But coming back to that point, that if I am offsetting dollar decline just to get back into dollars, is very different than saying the money's broken. I don't just need to hedge inflation. I actually need a solution. I need a new form of money,
right,
that is not structurally engineered to lose its value. Because if I've got a problem and it is with my money, the only possible solution to that can actually be a different form of money to perform the same function, right? It's like the idea that if my car is broken, I actually need a new car to solve that problem,
right?
And kind of if that kind of analogy makes sense. And so when I think about the problem being the Federal Reserve creates more money, then more debt is created on top of that money that's created, or more credit is created, that it is a man-made problem. 1 trillion in 2007 existed, 9 trillion exists today. The Fed will create more, understand the reasons why, but that is a certainty, that if the problem is printing of money or the creation of money digitally, however you want to think about it, then the permanent solution to that is removing the ability for any amount of money to be created at an end state. And that's what Bitcoin represents. So it is this very stark dichotomy between the problem, printing money, the solution would be a form of money that can't be printed. And then the question becomes, is Bitcoin that? And that the hardest thing to understand about Bitcoin, I really believe, has very little to do with Bitcoin itself, and it has everything to do with money, because most people have not sat down and consciously considered, what is money? They thought about all the things in their life, about finances and economics, but all those build on top of money. And if they start to question what money is and what would make something a better or worse form of money, that's actually harder than if you just sat there and said, I'm going to ignore that this thing was called Bitcoin,
right,
and that it's just a separate form of money and it can't be printed. Would that be better as an alternative to a form of money that can be? If you go through that thought exercise,
right,
99 out of 100 people are going to say yes, and one person might say no.
Except for the Fed has done really good by tricking people into thinking that the money supply is always supposed to expand, right? So a lot of people think, well, if the money supply doesn't expand, well, then economic activity is going to halt.
I actually think that that's very few people, but they've been very effective at echoing that through mainstream.
So they haven't stopped to think what that means, but they do echo it.
I think that, right, correct.
Yeah.
But I think that at the same time that everyone's come to understand that that is a certainty.
That the money supply will keep expanding?
Yeah. Or maybe less so that the money supply will keep expanding, but that the price of the goods that they need continue to go up, right? But not rational, economic actors, anybody that produces anything, intuitively knows that that's not sustainable or functional.
Right.
Right. That
Mises had the crack up boom, and he says, and then suddenly the people realize that inflation is both intentional and never ending.
Yeah.
And then all of a sudden they don't want any more, right?
Yeah. And so I guess the point I'm making is that the person that's sitting there whose income is not going up by 30%, but the food at the grocery store is, they know that, like, it's like if you're making an academic argument that the creation of money is good, that's irrelevant to me. I know that the things that I need to purchase going up in cost while my ability to earn is not matching that is not a good thing.
Yeah.
Right. And so that's where common sense comes in for a very small fraction of people that really are in the 1% that have assets that are offsetting this. I mean, realistically, at the end of the day, when a currency hyperinflates, it destroys everybody's, or doesn't destroy necessarily. It everybody's standard of living in that world declines.
Yeah.
But that the vast majority of everyone intuitively and via common sense knows that the price of everything around them going up does not serve them well.
Yeah. So Bitcoin has a fixed supply cap, 21 million, versus the dollar has no supply cap, and it's growing at a faster and faster rate as we go through time. You made a point that I want to ask you to expand on. So a lot of people might say that Bitcoin is risky because it's too volatile. It was 69,000 and now it's 21,000. It's way too risky because it goes up and down wildly. And you said that there's a distinction between risk and volatility, and you have to look at those two things differently when you're looking at Bitcoin.
Yeah, and I'd like to frame this from the perspective of, an overarching kind of theme to this piece, Bitcoin is not a hedge, is that one of the most common questions, or maybe not even one of, the most frequent question I've received over the last 12 to 18 months is, I thought Bitcoin was supposed to be an inflation hedge. There is inflation. Why is Bitcoin going down?
Right.
And I really make the point that it's not an inflation hedge for the reason that it is replacing the dollar, and that there's a fundamental distinction between that, but trying to help people understand why those two things could be consistent, why Bitcoin could both be the solution to inflation and the permanent replacement to the dollar, while for an intermittent period of time, the value could come down. It might go up at the same time,
right,
when the reverse is happening, but the fundamental doesn't change. And that when I bring that to kind of this concept of, imagine very few people in the world understanding Bitcoin, which is the reality.
Sure.
If you're somebody who doesn't understand Bitcoin, you are in the very, very large majority. If you are someone who kind of has started, and when I say understand it, started to see it as money, started to key in on the fact that there will only ever be 21 million and that's the value proposition, just in your common life, think about, like, do 1 out of 100 people in your life that in your orbit, do they also get it? Is it 1 out of 100? Is it 2 out of 100? Is it 1 out of 200?
And then out of those 1 out of 100 or 200, then how many of those actually understand what money is on top of that?
Right.
Which is a whole other.
See, that's the point that I make, that you almost have to get to that point before
Right.
you can start to understand Bitcoin.
Right.
But the point being that Bitcoin is very difficult to understand, and most people do not even know where to start.
Mm-hmm.
And so in the face of inflation going up, or FTX failing, or 3 arrows or Celsius, whatever, if you do not have an anchor point to understand what the fundamental value proposition is, then how can you evaluate any piece of information? Right. And so I try to lay out a framework to understand kind of what's been happening, the dynamics of inflation, but also to provide a roadmap to, if somebody wants to understand Bitcoin, first you have to understand that the value proposition derives around the fact that it's a form of money that can't be printed. Most people might not even know that, or even ones that do know that, then might not understand why that's consequential to the nature of money, right? And so it's kind of to establish that idea of, kind of leading up, and I'll come to this point that you asked about, where it's, risk versus volatility, which is the way that I would frame risk is the degree of future uncertainty, right? And then the question is, well, how certain or uncertain is Bitcoin? And to use a kind of a contrast, if I'm trying to estimate, say, how many iPhones are going to be sold, how many people are going to demand iPhones, how many people are going to demand phones, how many competitors might exist, that there's a lot more uncertainty embedded in that. But that if you start to understand that the value proposition around Bitcoin is there will only ever be 21 million, and that you might not understand how or why that happens or its relevance, that the certainty that can be created around identifying whether or not that is true, there will only ever be 21 million, is a lot more knowable than what one company is going to do in the world, how many goods or services they're going to be able to sell, and how much money they're going to be able to earn. And so this idea of, because it's risk and certainty versus risk and uncertainty, and then volatility. Because yes, Bitcoin is volatile, but if you came to the conclusion, as an example, that it was becoming more and more certain in your mind that Bitcoin could credibly enforce a fixed supply of 21 million, that fixed supply, the form of money that can't be printed, is the value proposition, and that you start to develop a framework as to how it happens, and that the thing that happened in the day that caused some people to question it, that caused the price to change, if you anchor to that is known and it is certain, then you start to see the volatility as essentially information asymmetry of not a lot of people understand that. So what they're reacting to is not the actual signal. And if you have that guidepost, I think about it as a lighthouse. If you have that lighthouse, which is Bitcoin is valuable because there will only ever be 21 million, and I understand how it's enforced, or at least have some framework, then everything else is moving around it, and that is the certain thing. And that, a lot of times people on TV, academics, even macro investors will say that there's a risk-free rate, and that people have been conditioned that way. But there realistically is no, there's nothing riskless in the world. That everything exists on a spectrum, and it is between what is most uncertain and what is least uncertain. And that if you start to think about risk in that perspective of things that are knowable or certain, and recognizing that nothing is 100% knowable, that in Bitcoin, and this is the case I lay out, is that that for people that start to develop that framework of this is why Bitcoin is valuable, and I start to understand how it happens, then it becomes the least uncertain good in the market. And so
there's more knowable things about it, for sure.
There's more knowable things on an absolute basis, but then also relative to all other things, within the economic system.
Then the big uncertainty around it is, will enough people choose that?
Well, and that's where
because we know the fixed supply, we know where we can learn all of that, but then the big uncertainty, because it's new, right? And will enough people move to that because of those features?
And I would say that there's a fundamental reason why they will have to, and that it is because everyone needs money and everyone has the incentive to hold the best form of money, and that the best form of money is the one that has the lowest rate of change. Now, there's a lot packaged in there, but it's on each person to evaluate that question themselves. And it's not so much does every individual have to arrive at the same conclusion. It is do enough arrive at the conclusion where everyone else gets dragged along. And then the question becomes, well, what's your alternative? Because you have a problem. The money that you use on a day-to-day basis gets created at no cost, and that you are going to have an alternative, right? And money never, it doesn't exist within a vacuum. It exists and competes with all other forms of money. And so, you know, in the way that I got into Bitcoin, I'd recognized that the dollar was a problem, and that if a central bank could create trillions of dollars overnight at no cost, that people were going to stop valuing that was going to stop functioning as money. So to me, I think when people go down the rabbit hole, it is if Bitcoin has a credibly enforced fixed supply of 21 million, B will happen. If A, then B.
Because we have to put our money somewhere.
Because that is the input. If the input is credible, then you have a form of money that can't be printed. And that nothing can have, you know, what would be better? A form of money that can be increased at 2% a year, 1% a year, 0.8% a year, 0.6%, 0.4%, 0.3, 0.2, 0.0011, right?
Or a better question is, how much of your wealth would you like to lose per year?
Right. Yeah.
0% or 1% or 10%, right?
Yeah. And I think that it's more so that most people do not understand why Bitcoin, like, even if I got to the point and said, okay, I would accept that if Bitcoin had a fixed supply, that might be a value. Most people walking around the world today don't even know that. Right? Then the next layer might be, well, you say that Bitcoin has a fixed supply, but there's 1,000 other cryptocurrencies. How do I know it's going to be this one? Right? And there's some inherent questions about what is money. So I think it's less about, like, if all of those things were true, do they still choose it? It's that those things, it's more so if those things are true, it's just a matter of knowledge being distributed, because they will have to if it is true. And that there, you know, I have a chart in there which is just a Bitcoin price chart, but it's as a function of time, knowledge distributes. People do not adopt Bitcoin as a standard of value because of any single event, because there's inflation or not inflation, because the Fed printed money, you know, tomorrow or the next day. It's that they have to develop a cumulative body of work to make sense out of this thing, Bitcoin being money, or what money is, at the very kind of most fundamental level. How you know, not everyone's going to have to, just like not everyone knows how a telephone works. Most people are able to use a telephone. That when we're in this early phase of Bitcoin adoption, people are having to make the conscious decision: is this money and is it not? But not everyone's going to have to do that.
So if it's a different monetary system, it's a solution to the inflationary monetary system where they constantly expand the money supply, and now we move to a new monetary system where they can't expand the monetary supply. There's trade-offs with that. There's pros and cons. So in an inflationary environment, the economy can grow rapidly. I could go out and buy 10 houses and 10 trucks and expand my business. In a fixed monetary supply, then that wouldn't be possible. And this is one argument that we might hear a lot, right? So it's like, well, how does the economy grow if the money supply doesn't expand?
I disagree with that.
I'm asking you. This is kind of something I hear a lot.
Yeah, I think I disagree with the idea that if I create more money, the economic system can grow faster, which because I actually think it's the opposite. In dollar terms, more dollars can be spent, right? But there's nothing really, nothing really relevant of more dollars moving around if more goods and services aren't being created, and it's not as black and white as one or the other, but that I would challenge, like, because this is I want to say a fundamental fact, but I think it's a fundamental economic truth that the creation of money actually impairs the economic system's ability to function. So it might feel like to take a hit of a drug and it feels good for a second.
Sugar
and then,
rush.
like you're, you know, destroyed. But that the only way I feel like to make sense of this for people is that if you have a form of money and just at any point in time, I have worked X number of hours and I have saved X number of unit of currency. As a holder of that currency, would it ever make more sense for somebody else in a far off land to be able to create it? Does that help you in any way?
No.
Did that increase your ability to go buy 10 houses? No. And so really, like, I think the problem that, or the mistake that people make is focusing on the aggregates and being like, oh, that sounds to make sense. They make more dollars and we can produce more things because there's more money. But in reality, the increase in the form of money didn't do anything to make more manufacturing plants, right? Like, it didn't do anything to produce more oil.
Well, maybe that manufacturing plant would have never been built if someone couldn't have got the loan in order to go and build that.
But there you go, right? Get the loan, right? Who says that you need a loan to go?
Well, you'd have to save up the money otherwise, which someone might not have.
Right. But who produces the oil? Human beings do.
Right.
Right. So realistically,
to make the factory, the steel, the concrete, or whatever.
Right.
Yeah.
That if that the input is actually human time. So you getting a loan doesn't necessarily, or doesn't increase the number of people that have the capability to actually go out and produce a barrel of oil. Right. And so the thing that's going to make oil cheaper is either more people producing it and making it more abundant that way, or finding better ways to do it. Not, I think these two things have become conflated. Not the creation of credit to let me go do it now.
Yeah.
Right? Because the alternative is you could save, and how do you save?
You got to less than you produce.
Consume less than you produce, but you got to produce something,
mm-hmm.
right? You got to go earn the money to then be able to go invest, whether it's in producing an oil well or producing TVs. That the creation of money, it's like it doesn't change a skill set. It just changes how economic resources are allocated, and that I think that is one of the things that people struggle with the most. I wrote an article called "Bitcoin is the Great Definancialization." That was the last one that I wrote before I took this hiatus, which people struggle with this idea of a fixed money supply and that being bad for an economic system. It's, again, first think about yourself. I've saved X. That's the most important thing. And then, because the economic dilemma multiplied 8 billion times over is the same. The macro is, imagine there's only 21 million Bitcoin. No more can be saved at any point in time, right?
Yeah.
But that actually creates the incentive for more people to save. If there's a form of money that has the economic incentives that is, this form of money is not going to degrade in value. It cannot be created. No more of it can be created. That actually creates the incentive to save, and the creation of people saving actually creates more people in the economic system to be able to buy things on a sustainable basis. And so when you, because it is an interesting thought exercise. Like, if there's 21 million, 100% of the 21 million are always being saved by somebody, no more or less, but there's more people who actually have an incentive to save. So what ends up happening in that system, and we have, we've seen this, that Bitcoin continues to become more and more decentralized. As more people adopt it, you have to deliver value to somebody that holds Bitcoin in order to get it away from them. And so when you kind of think about that in the context of, like, where do the incentives lie? It's like, and will people spend a currency? Because this is the other thing that people struggle with. Will people spend a currency that that can't be printed? Like, it creates a disincentive to spend. Well, imagine there's 21 million Bitcoin. Imagine there's 8 billion people in the world. Imagine all 8 billion of those people need to eat every day and need to consume power every day. That there's not going to be a problem of people spending money in a fixed supply regime. And I feel like I don't want to say the only people, but it is easy to get caught in that trap. But imagine there's only 21 million Bitcoin. Imagine you have some of them, and imagine you need to eat and that you need gas. Are you not spending your Bitcoin? Right. So I think it's a false dilemma, and that what actually happens because of the incentives is that you do not get, like, it is crazy that we live in a world where, whenever you see one of those statistics where it's like 50% of people in the United States do not have $500.
Yeah, no savings.
Right? Well, that exists because of the incentives of the economic structure. No one has savings. So a little bump in the road happens, and now that economic actor, once that first 500 gets subtracted, they can no longer consume it in the system.
Yeah.
And that if you flip the script, if you have an incentive to, it's like, again, like, these are very like common sense concepts. If you create a disincentive to save, people will not save. If you create an incentive to save, people will save. And that actually creates economic balance. Economic balance and more people having savings translates into more people that can go out there and consume in the economic system, but it also creates, and almost by definition, producers.
Yeah.
More producers, more savers, more goods.
So do you think it's
cheaper things?
You mentioned like a hit of drugs. So like if I was taking an artificial stimulant, I could maybe work faster and longer now, but then I might have to go sleep for 2 days. So maybe at the end of 3 days, I'm behind where you were naturally. Something like that? Is that how you're...
No, I think about it more like, use the analogy, and I have to give Safe credit for this one, but it's like heroin. Never done heroin, by the way. But
who told you about it?
Know some people who did. But that you take a hit and it makes you feel good, supposedly, and that you get addicted to it. Well, first time maybe it's okay, second time maybe it's okay, then you could become dependent on it, and that you need to get off that and go through withdrawal, otherwise you have certain death. You die on the table, right? That drugs are addictive, right? So if you could say, like, I'm only going to do it once, maybe it's worth the experiment. And that I think that that heroin is the best analogy, or something that is terminal in terms of.
But I was thinking like a stimulant, because a stimulant would speed me up temporarily, so I might be more productive in the beginning, but then as I come down, I'm less productive.
Yeah,
right? So more money in the ecosystem makes the economy more productive. Like, now there's a bunch of money, go try a bunch of things, bunch of malinvestment, whatever. But like, we go create a bunch of things, but then it causes the decline.
Right, but it would. I think in that world, it would assume that you get back to some stasis, and that's not necessarily how the real.
If you keep doing speed, or I would imagine you die too.
Yeah, and I think one, or like probably the practical thing that happens here is that if you think about, because there's nothing inherently bad about credit, by the way, that some of, I think, when I write, or maybe people might interpret that if people read my piece, but that the way that the U.S. financial system works is it's all debt based, and that if it was merely a function of, and this is where I kind of differ from some of the other people that think credit creation is money creation. I'm someone who would disagree with that statement.
It depends on the type of credit.
Well, no, I would just say, like, if there was a fixed amount of money, because like what you're describing is if there's a fixed amount of money and we get into a period where there's a lot of credit expansion, but if you can't actually create more money, the governor is going to ultimately reset the balance.
Sure.
It's not going to let it get untethered from reality. Well, in the Fed's world, we create a lot of debt, and we create so much debt that it's unsustainable. Well, rather than reducing the debt, which would be you coming off speed, and like you ran hot, now I got to come back because, a bunch of people got in debt that couldn't, and we come off and we slow down. In the Fed's world, they just keep applying more. They apply more dollars rather than reducing debt out of the system.
Right.
right? And that in that world, you get so far away from anything that is any semblance of reality, where you actually become dependent on the drug, which in this case is debt.
Yeah.
That system fails entirely if they do not supply more dollars to be able to service the existing debt level. It all collapses.
Yeah.
And because the entire system is based on credit, the system as a whole collapses. So I do think that, I mean, it is, I think what actually is the state of play is different from that I take speed and I run fast. That would be a world where we're on a fixed money supply, more money can't be created and credit's created, and now like there's a governor, which is the actual supply of money, which can repay debt.
So using this theme, and to kind of wrap it up here, put a bow in this here, then the patient, the economy is on heroin, addicted to heroin, which is money printing by the Fed, and the patient's terminal.
Yeah.
And the only way to keep them alive is to keep printing, and once they keep printing, then the patient dies.
Yeah. And another way that I would think about it is that you have to quit the drug, or if you quit the drug, you're going to go through a period of withdrawal, and that's not going to be fun.
And maybe even die.
And maybe even die.
Yeah.
But you have certain death if you continue to do it, right? And that is the, kind of probably the best analogy.
And the certainty of that outcome is almost the same as the certainty of Bitcoin's fixed supply.
For people that get far enough down that rabbit hole. And that in a less dystopian way to think about it, it's just like people inherently know that they have a problem. They know it's a problem, that their money purchases less over time, that everything around them goes up in value. And humans instinctively, Darwinian survival of the fittest.
Yeah.
I recognize I got a problem. I recognize I need a solution. It's hot outside. Let's build a house and put air conditioning in it.
Yeah.
Right? That's a solution. My money continually degrades and prices are going up. I need to solve that problem. That it's a dilemma, and people who adapt will do best than people who fail to adapt. And the first piece is knowing where to focus energy. Not everybody wants to understand Bitcoin, because that's something else that I say. Like, you can't help somebody understand Bitcoin who doesn't want to understand it. Sure. But that somebody then who says, like, I want to try to understand this. Like, they typically make a few classes of errors. They're like, I'm not going to be able to understand this, and they kind of shut down.
Yeah.
That's probably the most common. But that if people have a roadmap, which is, if you want to understand this, the reason why it's valuable is that it's engineered, because another critical distinction of it was that Bitcoin is capable of facilitating direct commerce. That most inflation hedges cannot. Mm-hmm. An equity index can, a piece of real estate can, sure. a piece of gold functionally can. But that most people do not know the roadmap, and that's really kind of, it's like, look, I want to help people understand inflation. I want to help people understand why the direction of Bitcoin, even though I don't like talking about the price of Bitcoin a lot, and I think about its purchasing power, like, we all still live in a dollar world. Mm-hmm. A dollar is the unit of account, and it's, kind of almost nonsensical to run from that. But that people intuitively know that there's a problem. They generally don't know where to start when it comes to trying to understand Bitcoin. Mm-hmm. And that if you are out there and you recognize that it's a problem, then you intuitively know you need a solution, and it's well worth the time to evaluate whether Bitcoin is or isn't, and that it's actually a lot more manageable if you've got a roadmap. Mm-hmm. If you have a logically ordered, help me understand not necessarily everything about the computer science or the cryptography or the distributed systems, but starting at the why, and then kind of working down the rabbit hole from there.
The thing I would say, just to add on to that and encourage people listening, is in order to be successful in anything, sports or business or investing, you have to find your edge. Like, you have to figure out what do I have that most people don't have. With investing or business, like, what is it that I know that most people don't understand? Like, what are they missing, right? And so in a free market, if we do a trade, both sides have to believe they're getting the better deal. And so what is it about Bitcoin that people are willing to sell their Bitcoin? They don't understand that I might be able to do some research and figure out, and I think that I'm getting a better deal and buy. And so for someone like us who've spent a lot of time, when we see the roadmap, kind of what you're saying, it's like we see the opportunity and we can see what people are missing. And so I think if people do that research, they can gain that edge. They can see the roadmap. They can see what people are missing, and they could be on the receiving end of that trade. So good point.
Yeah, and I think just to quickly expand on that, one analogy, or maybe not an analogy, but one way I would explain that is a lot of people think that Bitcoin's too complicated to understand, and so they don't attempt to go down. It's almost a defense mechanism, like, oh, if I try and fail, what does that say about me?
Right.
And what I like to reinforce for people is that it's not an IQ test; it's a common sense one. And it's a lot less complicated or a lot less complex than it seems at the surface. But that if you wanted to train yourself to be a doctor, 10 years. If you really want to develop any craft,
get a black belt in jiu-jitsu.
Yeah.
10 years.
Yeah. Obviously, not many people get to be an NBA athlete or an MLB or a pro athlete, or even make it to the minors, or even get to play in college for that matter. But just think about an athlete that plays in college. They started playing that sport when they were 8 years old.
Right.
It takes a decade. If you want to understand Bitcoin, it takes some intentionality. Maybe it's 40 hours to start making sense of it. Maybe it's 100. And someone might say, that's a lot of time. Where am I going to find 40 hours or 100 hours? But when you start to think about, well, if I want to understand how to do anything very well, if I want to do a craft, years, that if Bitcoin is or has the potential to be the form of money that the entire world adopts, that when you start to evaluate 40 hours or 100 hours for, I could be clued into a massive advantage that most people do not understand, that there could not be anything more worthy of that time, because it's like, well, what are you going to do? You think that you can effectively invest in stocks with less than 40 hours of time? And it's like, what we're talking about is a sea change in the form of money that everyone uses in the world, and that is the bedrock of the economic system. That when you start to evaluate, is it worth the time? If that is the asymmetry that is involved, that 40 hours really isn't that much, or 100 hours isn't that much, and it is well worth the time, and that if people spend that time, they will be able to discern. And I think that that's the hardest thing, is to invest the time, but then also to have the confidence that if you do invest the time, that on the other side you'll come away with, you don't have to necessarily come to the same answer as I, but what I would say to people is, it's worth the investment to know.
I don't know anybody who's ever put in the investment of time and walked and said, nope, it's all a scam. Like no one's ever come away from doing the work and doing the research. I would say that sounds overwhelming to a lot of people. So just read Parker's papers.
Yeah. Well, that's
start with Parker's papers one at a time.
That's also why I wrote the papers the way I do, which is some people genuinely do not have, and this is also, when I say that, like, someone doesn't set out and say, I'm going to spend 100 hours. I'm going to make that 100 hours commitment. But that it's a commitment to read a book. And a lot of people genuinely, like, they have a lot of shit going on in their life, and picking up and reading a book about Bitcoin might be like not enough hours in the day, right? But with my pieces, I've written them in such a way where people can, they typically have common questions, right? And people can sit down and read an essay in 30 minutes, and it's not as big of a commitment as reading a book. But it does go through the fundamentals, and it's just peeling back the layer of the onion. So it's like, it's literally getting there and reading one article and spending 30 minutes. And then if someone's intrigued, read the second 30 minutes. Maybe then pick up a book if it's starting to make sense. That it doesn't have to be all or nothing, but that the first step is starting to consume something fundamental about Bitcoin, rather than, what do people say the price is going to do? Like that's, cart before the horse.
Yeah. So we'll link to all Parker's papers in the show notes down below and read those one by one. Thank you for taking the time to talk today. Unchained.com, Unchained Capital. It's the best place to secure your Bitcoin. It's what I use. And so you should check it out. We'll link to that as well. Anything else? Any parting words?
No, but the series is on the blog at unchained.com.
Yep,
so
on Unchained,
if you go under resources, it's under the blog, and then the Gradually Then Suddenly series, abbreviated for GTS. People can find me on Twitter, Parker A. Lewis.
Yep.
My Twitter handle. And then, we're here in Austin, hanging out at the Bitcoin Commons and Mari's TFTC studio. So if you're ever in Austin, be sure to look us up.
Yeah. All right. We'll link to all that down below. Thank you so much.
All right. Thanks, Mark.
All right. That's a wrap. Thanks for listening to the interview with Parker Lewis. We're going to link to his stuff down below. We're going to link to this article that he just wrote, his 18th installment of Gradually Then Suddenly. I highly recommend you read it. There's a link to it down below and the rest of his stuff if you want to give him a follow. Of course, as always, I ask if you give me a like on this video if you liked it. If you don't, you can give me a thumbs down. That's okay. Leave me a comment. Let me know what you think down below. And of course, as always, hit that subscribe button so you know when I put videos out. And that's what I got. To your success.